we have Dr. Anas F. Alhajji, Jesse Thompson, Brian Matlock, Buddy Clark, and our moderator for the day will be Dan Pickering. So for the order of the day, we will be doing introductions and welcomes from 7 to 7:05. From 7:05 to 7:10, we will do a brief overview of the FENG, the Financial Executives Networking Group. From 7:10 to 7:15, Jesse Thompson will be introduced. I'll do his biography. Then Jesse Thompson with the Federal Reserve will present a market overview from 7:20 to 7:25. From 7:25 to 7:35, I'll do some panel introductions and biographies. From 7:35 to 8:30, we will do our fireside Q&A, Bloomberg style. Dan Pickering will be our moderator. If you have questions, please send them through the chat. Then from 8:30 to 8:50, we will be fielding audience questions. Dan Pickering will do a brief summary from 8:50 to 8:55, and then we will be closing from 8:55 to 9 p.m. Everybody should have their cameras switched off and their microphones switched off. Thank you very much for joining us. And so now I'll do a brief overview of the FENG. The Financial Executives Networking Group is a 501c3 organization founded in 1991 as a forum for senior financial executives to share deal flow, job opportunities, and experiences such as this one. Members have titles such as Chief Financial Officer, Controller, Treasurer, Managing Director, as well as Vice President of Tax, M&A, or Internal Audit. Under the leadership of Matt Budd, the FENG has grown from a small Connecticut-based organization to one with nearly over 40,000 members spread across the United States and internationally. It is the largest networking group of its time in the entire world. Matt is a volunteer, as are the over 200 plus individuals in our leadership, such as myself. He's also managing partner of the Financial Executives Consulting Group. Our members currently represent the senior financial management of over 8,000 private, 250,000 public companies. Over 40% of our members work at companies with sales of over $500 million. And now I will introduce Jesse Thompson. Jesse Thompson is a senior business economist with the Federal Reserve Bank of Dallas, Houston branch. Jesse Thompson serves as a senior business economist at the Houston branch of the Federal Reserve Bank of Dallas. Mr. Thompson, who joined the bank in 2010, performs research and analysis on issues affecting the Houston and Gulf Coast economy. In particular, he studies issues surrounding areas of hydrocarbon industry. He also collects information for the Dallas Fed's Beige Book Summary of Current Economic Conditions. He's an author of the monthly energy indicators, the Houston economic indicators, and contributes to the quarterly publication, Southwest Economy. Mr. Thompson earned an MA in economics with an emphasis on empirical microeconomics and a BA in philosophy and economics from the University of Houston. Jesse Thompson.
Good morning. Oh, yeah, there's a lot of glare there. Let me get off the camera. Good morning, everyone. I hope everyone is safe and healthy. Let me get my slide deck going here. Desktop window. Share. All righty. So the energy outlook. So I'm gonna give a little bit of a similar talk last time. I'm gonna keep it the slides relatively brief. Before I get into that, as always, let Let me get this thing going here. Do a little bit of a pitch here. You know, in my work for the Federal Reserve, you know, Mark mentioned that I collect information for the Dallas Beige Book. When there are special circumstances, I often will call industry contacts that I've kept or who need to reach out to me. Many of them are participants in our surveys. We send out special surveys to our survey participants. And from me to, I know there are many people in this audience who've participated in our surveys in the past or who have contributed to Beige Book calls in the past. From the bottom of my heart, thank you very much. Economic data comes with a lag. And the economic analysis comes after that. When these unforeseen events or when black swans, like what we've been going through here for the last several weeks, although it feels like several months, when that happens, you know, the economic data isn't there, and we rely on the Fed heavily on intelligence that we get from real business people, real business leaders making real decisions in the real world every day, like the members of this, of this panel, and like the people calling in today. If you have not participated in our surveys before or are interested in doing so, please consider signing up. You can reach out to me. You can reach out to us through our website. We would very much love to hear from you, both to know both the answers to the questions that we ask, plus we'd also like to ask you what questions we should be asking. And we need feedback about, you know, what we're doing and how this is affecting you. So please participate. All right. Now then, sales pitch over. As always, I have to say that my opinions are mine and mine alone, and not necessarily representative of the views of the Federal Reserve Board of Governors, bank presidents, officers, or anyone else associated with the Federal Reserve Bank in no way, shape, or form. So with the disclaimer out of the way, let's just give you a quick state of play, and then we can get into the real discussion with the other panelists. So first off, looking at this chart, what you've got is indexed to April 2019. So you can look at it on a year-over-year basis, or you can even just looking at the chart here from March. Consumption really fell off in April. Jet fuel is down about 75%. Gasoline is about cut in half. Distillate has been cut by about a third. And then there are other products that are out there. They haven't really fallen off by much, but those are small volumes by comparison. So demand has really fallen off as a result of efforts to contain the coronavirus. Shelter-in-place orders have kept anyone from driving, and of course, you know, cramming a bunch of people into a crowded airplane and sending them country to country. Well, that's not happening so much anymore if it's not essential. With that fall off in consumption, we've seen fuel inventories really rise. So gasoline days of inventory. Now, this is U.S. supply data, but this is fairly representative of what you see if you look at OECD data. And it's probably similar to what we're seeing outside the OECD. Gasoline days of inventory in the United States is now at 47 days on a seasonally adjusted basis. I didn't extend this series as far back as it could possibly go, but suffice to say, I had to change the scale of my slide here in order to make that hockey stick fit. Distillate inventories are rising as well, still not as high as they were in 17 and 16 in terms of days of supply. Days of supply, for those of you who don't know, is the ratio of current inventories versus current estimates of consumption. And this is weekly data. So that's really spiked up here in April, particularly looking at the last data point there is the last week of April. Please mute your microphones. All right. And with that fall off in consumption, of course, we've seen refineries lower the amount of crude that they're processing. If you look at this chart, this is the blue line is the darker line, the black line there, that is the Gulf Coast refining pad district. And then you've got the rest of the United States. The Gulf Coast, thousands of barrels per day, is down 16% in April. And down 21% in the rest of the United States. Now, on the Gulf Coast, that decline is on par with the kinds of shutdowns you would expect in the event of a major hurricane like Hurricane Harvey. That still doesn't approach kind of the disruption that you saw back in 2008 with hurricanes Ike and Gustav back to back there. But when you look at the rest of the US, nothing like this has ever happened outside the Gulf Coast. When you look at the rest of the United States, we've never seen a drop off in crude processing of this magnitude. But with consumption of products down and the amount of crude being processed by refiners being down, as it was alluded to in that earlier slide, you're seeing inventories of crude oil rise rapidly. Production was still growing, at least through March, and we expect through April. And at least in the early parts of April, we were seeing crude oil production still rising. We were seeing consumption by refineries slacken. And so we saw a rapid increase in crude oil held in stock. So Cushing crude inventories shot up there at the end of the sample. Crude oil inventories, commercial crude inventories outside of Cushing were also rising quickly. And even natural gas stocks. Natural gas stocks were rising quickly on a seasonally adjusted basis. Now, a lot of people might wonder what's going on with natural gas stocks. Well, industry is a heavy consumer of natural gas. Industry is a heavy consumer of natural gas, both in the refining and petrochemical sectors, both as a raw material and as a source of heat and as a source of power. But also, natural gas-fired power generation is off about 14% from early March to mid-April. So natural gas consumption is off as well. Exports, for the data that we have, the data for exports is fairly lagged, but exports of everything seems to still be moving on at a clip. But that at a reasonable clip, but that should fall off. The exception there is jet fuel. Jet fuel exports have seen a bit weakening. So, crude oil inventories are rising, consumption's off, and of course we've seen prices collapse. Now, what you're looking at in this chart is Brent is the dark line, the black line on top. That's Brent crude. The dark blue line on the bottom, that is WTI Midland. That's the one I tend to follow most closely. And then I've got the Houston. That's Magellanese Houston there on the chart. You see them falling off, and you see March really dipping down there into the 20s, and then dipping further down into the low 20s and teens for inland prices. Now, the chart that I was pulling together here to show the day which will live in infamy, which was April 20. That was the day WTI Cushing went negative. That chart wound up having some problems, so I cut it last night. So I cut it from the slide deck. But yes, for a variety of reasons, most notably that we are seeing these inventories rising. We saw a lot of futures market traders get caught in late April and have to sell their contracts at a steep discount. We saw for the first time in history, WTI went negative, and I suspect that there's going to be more discussion around this in the panel. So I'm going to move on from there. But negative oil prices have now happened. Oil prices are weak, inventories are high, and it's going to take a long time for those inventories to be worked off. Those excess inventories that we are building right now and likely for the rest of this quarter, there's a lot of uncertainty around this, but sometime next year is about the time frame that we think it'll take for excess inventories built up during this coronavirus episode to be worked off. When you look at credit markets have soured on high yield energy even more than they already were. It's a spectacular effect here in the last few weeks. Now, this data is not as up to date as it could be. We have some new weekly data that was out last week that I did an update with here. But high yield spreads are still very, very high for energy. So access to credit has been diminishing. We already knew that equity markets were closed to the industry as far as a source of funding. And then we're going to talk a little bit later about what's happening with bank debt and reserve-based lending. Suffice to say, access to capital was already strained, and things are, with this, what's happened in the market, it's gotten worse. With the industry running out of storage capacity for crude, you've seen, and with prices plummeting, you've seen oil field operations really get curtailed. So rig counts are down sharply. You can see here, you see the Permian Basin, rig counts down to 246. If you look at other oily shale basins, they're down to 83. And then the rest of the US is down to 136. Rig count has really fallen off. But it's not just the rig count. Now we don't have real-time at the Fed. We don't pay for real-time data on from satellite entities or outfits like Rystad, where they track completion crews, frac fleets that are out there working. But from what we are told by those outfits that do that work and from industry contacts, we're also seeing completion crews, frac fleets cut by about half. So oil field operations are really being cut deeply in reaction to what's happening with the physical market and with oil prices. So to bring this home in terms of what does this mean to me, I am at my heart a regional guy. I'm a native Houstonian. And so when I talk about jobs in the oil field, I'm oftentimes talking about my friends, my neighbors, my community. What you're looking at in this chart is data from the Texas Workforce Commission on cumulative initial claims for unemployment by sector. And this is by the mining sector. And for those of you who don't know, in the state of Texas, the mining sector accounts for is about 95% of that sector is oil and gas extraction. So that's oil field operations and E&P companies, oil field services, E&P companies. There have been cumulatively from 314 to 418 about 26,000, little over 26,600 claims filed and categorized by the allocated by the Texas Workforce Commission to the mining sector. To put that in perspective, you look at with this chart, see the black line here, starting at 314 and then accelerating its increase through 418. You've got about 111 there is the number on the right-hand side of that black line. That 111 means that there have been about 111 initial claims filed for every 1,000 payroll employees, according to the February payroll. So that's a little over 10% of the February payrolls in energy have now filed, had claims filed for unemployment through mid-April. And that's accelerating. Now, that's still not as hard hit in terms of the impact as accommodation and food services. That's what the BLS calls, say, like restaurants and bars, for example. Accommodation and food services was much harder hit early on in the coronavirus episode because, of course, as people stopped going home, people started staying home, stopped going out. They stopped going to restaurants, stopped going to hotels, et cetera. And so they were hard hit early. But notice that the impact is slowing. Claims are slowing for accommodation and food services. They're slowing for the rest of leisure and hospitality. They're slowing for many other services. Whereas you're seeing, at least through mid-April, you're seeing mining claims accelerate. So it's not a pretty picture out there. The industry's in a tough spot. And there's a lot of people losing their jobs. With that, I will end my slide sharing here.
Super. All right. So for our next section, and we are right on time or a little bit early, I will be doing panel introductions and biographies. So I'd like to introduce Mr. Buddy Clark. Buddy is the co-chair of the Energy Practice Group for Haynes and Boone's. Buddy Clark, the co-chair for the firm's Energy Practice Group, representing clients in the oil and gas industry, including banks, private capital providers, and producers in secured and unsecured credit transactions and equity investments, producers, joint venturers, and midstream companies in the oil and gas exploration, production, and development agreements, and producing property and midstream acquisitions, joint developments and partnerships, and energy-related litigation and bankruptcies. In June 2016, Buddy published Oil Capital, The History of American Oil Wildcatters, Independents, and Their Bankers, which traces the relationships between independent producers and their capital providers in America's oil and gas industry. Buddy is a frequent speaker at oil and gas conferences and is often cited as an authority on the current issues facing the oil and gas industry in trade publications and financial journals, which is obviously why we wanted to have him on our panel. I'd like to also introduce Brian Matlock, CPA, MBA. Brian Matlock is a partner with BKD LLP, the 12th largest accounting firm in the world, and serves as the firm's national energy and natural resources leader, specializing in oil and gas, private equity. Prior to joining BKD, Brian was a partner with KPMG, serving as one of the firm's energy private equity fund leaders. Through his experience with energy private equity funds, Brian has had experience with auditing and accounting matters relating to mineral extraction and power generation and energy companies such as upstream oil and gas, midstream oil and gas, downstream oil and gas participation funds, oil and gas royalty funds, master limited partnerships, oil and gas industrial manufacturing, workover, and wireline service companies, solar power, wind power, biomass, and other traditional power generation plants. In addition to his responsibilities at BKD, Brian is very active in the energy industry, serving as the former chairman of the North American Petroleum Accounting Conference and a current board member, a member of the following organizations: Dallas and Fort Worth Council of Petroleum Accounting Societies, Dallas Adam Energy Forum, Dallas Petroleum Engineering Club, and the Dallas Petroleum Club. Brian was also selected as one of the who's who in energy in 2013 by the Dallas Business Journal and was selected for the AICPA Oil and Gas Revenue Task Force in 2013. Brian is a graduate of Texas Wesleyan University, where he received his BA in accounting as well as MA in business administration and accounting management information systems. He is a member of the American Institute of Certified Public Accountants and the Texas Society of Certified Public Accountants. I would like to also introduce Dr. Anas F. Alhajji, a well-renowned energy markets expert, researcher, and author, a speaker with more than 900 papers, articles, and columns to his credit. He advises governments, companies, financial institutions, and investors on various energy markets issues. He focuses on the oil and gas market outlook, energy geopolitics, energy security, and the impact of disruptive technologies on the supply and demand of energy. Before his recent role as managing partner at Energy Outlook Advisors, he was the former chief economist of NGP Energy Capital Management. He led the firm's macro analysis of the oil, natural gas, and related markets, as well as the overall economic environment. He was responsible for the short-term and long-term outlooks for oil, natural gas, NGLs, and LNG markets. Dr. Alhajji's articles appear in numerous countries in more than 10 languages, and his work has been cited in over 60 books. He has addressed numerous companies, institutions, and national and international organizations. He also serves on the board of several energy-related publications. He's the contributing editor for one of the industry's premier publications, World Oil. He's also the moderator of the industry's oldest virtual forum, Oil, Gas, and Energy Law. Prior to joining NGP, Dr. Alhajji taught economics at the University of Oklahoma, the Colorado School of Mines, and Ohio Northwestern University, where he held the George Passon Chair of Business and Economics. Dr. Alhajji taught courses in economics, energy economics, policy, and energy geopolitics. And finally, I would like to introduce the esteemed Dan Pickering, our moderator for the day. Dan is the Chief Investment Officer of Pickering Energy Partners. Pickering Energy Partners manages clients' assets via energy strategies focused primarily on public markets and private equity. Prior to PEP, Mr. Pickering served as the president of Tudor Pickering Holt & Company and Chief Investment Officer of TPH Investment Management. Tudor Pickering and Holt Asset Management manage both public and private equity strategies for institutional and individual clients. Dan has spent 24 years as an energy portfolio manager and researcher and an analyst. First at Fidelity Investments, where he managed approximately $1 billion worth of energy sector funds, then as head of research at Simmons & Company, and as the founding partner of Tudor Pickering and Holt. He currently serves as the portfolio manager of PEP Energy Equity Opportunities Fund and the investment committee of PEP's Energy Co-Investment and Research-Based Strategies. Dan grew up in Missouri and has a BS in Petroleum Engineering from Missouri School of Science and Technology and an MBA from the University of Chicago. Introducing my esteemed panel for the State of oil, natural gas upstream, midstream, and downstream. Thank you.
Mark, thank you. Really appreciate the introduction, and welcome to everyone. We've got a great panel. I'm going to serve as moderator. I'm going to be jumping back and forth between our various panelists asking questions. If you see me looking down, etc., I'm checking my notes and taking my own notes. So I'm really looking forward to the discussion today. What I thought we might start with is just, Jesse, you gave an interesting presentation for how soft things are. Maybe give us your views on, do things get worse from here? How is the Fed thinking about the potential for demand recovery, and how does sort of virus resurgence in the fall play into that?
All right. Well, thank you very much. So what do we think about recovery? So we've hashed out a number of scenarios here. I'm not going to dignify it with the term forecast. When we're dealing with unprecedented data, forecast models go by the wayside. But scenarioing it out, we think that you look at gasoline demand, you look at distillate demand. Probably by the end of this year, we're going to get to something resembling normal. There will be a bit of a pop once we reopen the economy and people start going out again. But that's going to take a while. That's probably not going to be within much of a bounce back within the second quarter. We're really going to start to see it over the summer, but probably not before the end of the year for most of their gasoline and distillate consumption. Now, for air travel, domestic travel will probably see a stronger recovery than international, but it's hard to imagine a significant or a full recovery in jet fuel demand before we get a vaccine or some significant progress on medications to help combat the effects of the virus. But that all presumes that we don't have a second wave. We do not model a second wave. We note it as a downside risk. And part of the reason for that, and part of the reason why most of the modeling to date doesn't assume a second wave when you're just looking at the viral models, is that there's such a wide band of uncertainty around all the parameters as it is, that adding the uncertainties that around a second wave really make projections just really hard to do. So right now we don't expect a second wave, a wave in our models, but we have to note it as a significant possibility. In terms of GDP growth, and what does that mean for consumption? We are a little bit less bearish than, say, the IEA is on second quarter consumption. The IEA being the International Energy Agency. But we're also a little bit more, bearish on the second half of the year than they are. So we don't think Q2 will see quite as big of a fall off as the IEA has called for, but we do think the second half of the year is not going to recover as quickly as they do. If you look at, say, for a good benchmark for what GDP is going to look like in the United States, at least, the blue chip consensus forecast is calling for a 24.5% drop in second quarter GDP, with a recovery of 7.4 and 7.9% GDP growth in the third and fourth quarter. That makes for an annual Q4 over Q4 drop of about 4.2%. And that's a little bit on the optimistic side. Our view is that GDP growth will be hit a little bit more harshly than that, but that the second half of the year we'll see stronger GDP growth. But what it all balances out to is that, it's going to take, with recovering demand the way we think it's going and current assumptions about shut-ins around the world, we think we're probably going to see excess crude inventories persist into 2021, and with somewhere in 2021, maybe by mid-year, maybe not before the end of the year, those excess crude oil inventories that we're currently building finally being worked off. And in the meantime, those inventories are going to weigh on our industry.
Great, thanks, Jesse. Anas, you've looked at the same sorts of situations for a lot of your career. How are you thinking about the demand side, either recovering, bottoming? How do you think the kind of shape of this curve looks like for energy demand?
Yes, I am more bullish than Jesse on demand, but it's very hard to talk about demand without looking at the whole picture. As the fact is, with lockdown, there is no movement, but people are learning how to work around it. So whether the government act or it doesn't, people are going to be on the street very soon, regardless, and therefore demand is going to pick up. But we have to remember that on the supply side, we have major shut-ins, not only in North America, but worldwide. And that's going to play a big role in reducing supply and production on one hand, and reducing the growth in inventories on the other. Those who are talking about massive build in inventories basically are missing the point about the shutdown. The shutdown is going to reduce supply substantially.
Talk a little bit more about that. So we know OPEC has said they're going to take 9.7 million barrels a day off. Do you believe that number? How much do you think is happening in the U.S. in terms of economic shut-ins, and how much do you think is happening in the rest of the world based on low prices?
The OPEC plus cut, the 9.7, is irrelevant in the short run because that is oil that's not being sold anyway. So there is no impact for that in the short run. But whatever they cut, it's very positive and supportive in the medium term and the long term. As you know, they extended the cut to the middle of 2022. So any of that cut, even if you take 50% of it, is very positive. So, but in the short run, there is no impact. What we are seeing right now is major shut-ins in the United States and Canada. That is a forced shut-in because of economics on one side and some storage issues on the other. But this is not limited to North America. We are seeing a shutdown in China. We are seeing shutdown in India. We already seen shutdown in Brazil. By the way, there were news yesterday about kind of a recovery in Brazil. I really doubt that because it seems like it's more than a plan than it really happened. I think the shut-in is real in Brazil. And we have shut-ins in West Africa that's not being reported in the media yet. So we are seeing major shut-ins worldwide, and that's going to have a major impact by July and August.
Okay. And major means how much do you think U.S. production shut in? Just ballpark.
I think by August, between Canada and the United States, we will lose about 2 to 2.1 million barrels a day. By the end of the year, we might go above 3.
Okay. So you think that the more lasting impacts, that 3 million barrels a day, would that mean folks that shut in May and June and July are back, but productive capacities come down? Or do you think guys are going to continue to shut in because price stays soft?
Sure. For those who are following this, they can check my Forbes column. There is a chart there. Unfortunately, I did not prepare it for this show here. There is a chart basically showing the expectation that shut-ins will increase to the middle of the summer and then start declining again as the market tightens a little bit and there is more room for the extra oil. But this is not the big story. The big story is this, that shut-ins all the oil that's been shut in can come back, or most of it. Despite all the technical issues and all the losses, it can come back. What cannot come back is this. Historically, as we all know, that decline rates in shale wells are very high. And we compensated for that historically by increasing in investment, improving efficiency. So we increased production to compensate for the decline, and we added more that led to the increase in U.S. oil production. But now investment is down. It's already down by more than 20%. It might go even way higher than that. There is no compensation for the decline. So toward the end of the year, that's going to be another problem aside from the shut-ins, that there will be oil that we cannot bring online easily and quickly as a result of that decline rate. So we have a decline in investment meeting the decline rate, and that will lead to a major decline in production in North America.
So just pushing on that a little bit, you characterized yourself as maybe a little bit more bullish than Jesse, but it sounds to me like that's really being driven more by the supply side and the reaction of these decline curves, for instance, than, and maybe a little bit on the demand side, but the supply side is certainly influencing how you think.
Well, the reason why I'm bringing up the supply side here, because we are more certain on the supply side than the demand side. I mean, Jesse's comment about whether we have a second wave or what's going to happen on the demand side is correct. But we have more certainty on what's going to happen on the supply side than what's going to happen on the demand side. And that's why I'm bringing supply up.
Yeah, no, makes sense. So let's expand the question then to start thinking about the implications of what's going on for the industry. And so one of the topics that has emerged are things like government support for the industry, loans, et cetera. Buddy, talk a little bit about what you expect from external support for the industry, and then I'm going to ask Brian to weigh in on the same question. And you're muddy. Right now you're muted, buddy. I think we can hear. Yeah, we can hear you.
Okay. The external support for the industry is going to come primarily, I think, from the financing side, not so much from the industrial or regulatory side. Is there an echo going here?
Only for you. We can hear you just fine.
Okay, good. All right, that's fine. I can deal with it. So I think the discussion that we saw 2 weeks ago with the Texas Railroad Commission, perhaps imposing proration, is not going to go very far at all. I think Wayne Christensen came out pretty clear the other day in an opinion on that. And frankly, the markets, as has already been discussed, are taking care of the excess production that anything affect proration in the state of Texas could have any impact on world markets. So you have Texas, Oklahoma, North Dakota talking about some type of regulatory impact. I think the Oklahoma Corporation Commission's efforts to provide cover, if you will, for producers with respect to shutting in production by declaring force majeure may be the most impactful. Trying for the regulators to reduce production is unnecessary at this point. The financial side is more interesting because it's clear the public markets have really lost any interest in investing in oil and gas, and the commercial banks are also backing away considerably. So if there's going to be more capital coming into the industry, it'll probably be coming from federal programs, but even those are going to be limited. This amount of capital that the U.S. producer industry requires is massive. And loans of $2 million or $10 million are not going to enable companies to go out and complete their drilled and uncompleted wells or drill new wells. So I think the impact on oversupply is going to be dictated mainly by basic economics, supply and demand. Too much supply, not enough demand, prices go down. And as the prices go down, production goes down until demand comes back up, and we're back in that cycle again where prices are going back up.
Great, thanks. Yeah. Brian, your view around kind of potential government interaction, whether that's loans to business or proration, et cetera?
Yeah, so I agree with Buddy. I don't see much of an opportunity for the government to step in, especially right now. The government, when you think of what they're doing, especially say the recent CARES Act, was frankly just not designed for our industry. It's not beneficial to oil and gas. As Buddy said, with the loan amounts are either too small or the way the statute is written, it's just flat out not applicable. There are numerous rules regarding the size of the organization. So think of your larger capital-based public companies, Exxons of the world, et cetera. Obviously, you're not going to qualify. But when you think of your smaller private equity-backed companies, they don't qualify either because of affiliation rules, generally at the private equity level. So we're not, I don't think we're going to see much from there. You know, there are different rumors from a banking perspective that the OCC, which governs most of the banks that loan in the oil and gas space, may come down and be willing to work with the banks a little bit more. We haven't seen that yet. I would say it's right at this point, it's rumors. But there is some discussion of that. And I frankly think that probably will have to happen. The reality is they're all in a world of hurt. It's just a matter of, if you think of the banks, for the most part, the banks right now are triaging their oil and gas clients. They're looking at, they know they're all in a world of hurt. So it's a matter of which ones do they think can survive this mess and which ones are not going to survive. And the ones that aren't going to survive are the ones that flat out have certain key financial indicators or other factors that the banks just cannot get around the OCC regulatory environment, and they'll effectively, the banks would be hung out to dry if they turn the other way. So to answer your question, no, I don't think we're in a position where we're going to get much government relief at all. I think it's going to be the opportunity is going to be with the banks and with the private equity worlds, and frankly, those are going to be pretty tight with not a lot of opportunity either.
Dan, could I add a thought to that?
Please.
I think that's exactly the right direction that producers should be looking for some relief if we're going to get it. IPAA has been making efforts through the Department of Energy to talk to the Department of Treasury to try to get the OCC, which is one of the principal regulators for U.S. banks, to relax to some degree their standards for reviewing oil and gas loans. In 2014 and 2016, the OCC came out with some more restrictive guidelines on how banks should categorize their loans to producers, as whether it be criticized. The more criticized a loan is, the more reserves banks have to set aside on their books against possible losses, and that made it made it more uneconomic for banks to extend credit to producers. If those regulations could be rolled back a little bit, and that's what the IPAA is trying to encourage to happen, that would give the banks a little more flexibility to work with producers. Bankers are never going to purposely make imprudent loans. That's just not in their nature. But if they have some flexibility for the loans already on the books to extend deadlines, extend some credit to the producers, I think that would be a more fundamental assistance to the industry than any efforts via proration.
And Buddy, I know that you spend some time kind of thinking about bank activity. Can you talk a little bit about, notwithstanding the adjustments we might see from reserve requirements, et cetera, talk to us a little bit about bank behavior during redetermination season. I just saw several public companies show some fairly substantial downward revisions to their borrowing bases. Do you expect a significant cut to borrowing bases, and do you think that's going to push companies into a real liquidity crisis, or are they going to be okay?
I would like to be more optimistic. You can point anecdotally to a couple of companies that have announced their borrowing bases were even increased or held steady. But I would suggest you look under the covers on those borrowing bases that are held steady to a certain degree, and we're working with both borrowers and banks as our clients. There are agreements, not so much gentleman agreements, but actually in writing, that the parties will agree to keep the nominal borrowing base at a certain level, but the producer agrees with the bank that they're not going to draw down that facility. So that's a little bit of window dressing that you might see when people are announcing that their borrowing bases are being held steady. But we are definitely seeing situations where the borrowing bases are decreasing. You know, a 10% decrease is considered a victory in this market. And I heard from one of my other lawyers that one of the major banks was talking about decreases from 30 to 70%. And in my experience, over 40 years, that's just unheard of. So I would like to be a lot more optimistic on that. I think it'd be great for the loans that are on the books for the banks to have some more flexibility, but I don't see any influx of capital coming into producers right now from the banks or the public markets.
Your firm does a great job of issuing statistics around bankruptcy and the challenges that are ongoing. Can you talk to us about how Haynes and Boone sees the outlook for bankruptcy? I mean, what are kind of the numbers you're thinking about, either in absolute terms or percent of companies in the industry or something? Give us some markers for kind of how bad this is going to get.
Okay, we've been tracking it since January of 2015, and there were over 210 bankruptcies, I believe, as of April 1. That's U.S. and Canada. I don't see any question but that we could easily have half again as many bankruptcies before this is over. There are over 4,000 to 5,000 independent producers. Most of them are very small that you will never have heard of and may disappear without ever filing bankruptcy. But there's a lot of headline bankruptcies that are yet to be filed. And some of these are what we call Chapter 22, where a company went through bankruptcy 2014, 2015, and now they're coming back out. And with the prices where they are, they're going back in. So statistically, it won't be pretty. I guess I'm not going to be able to give you a definitive number or percentage, but I think we're going to expect to see a lot coming. And the bankruptcies won't just be oil and gas. It'll be oil field services, even hearing about some midstream companies that are being stretched. So it pervades the industry. This is unheard of that we're going through right now.
So your 50% number was, we've seen 200 and we might see another 100. Is that right?
Yeah, I'm afraid that's probably conservative.
Yeah. Jesse, would you add anything from the Fed's perspective? How are you guys thinking about or tracking distress in the sector?
Aside from what we've already talked about, we follow Haynes and Boone's statistics quite closely as well. When we look at banks, we check our banks for their criticized loan portfolios, our member banks, and we see what their exposure is to energy. And heading into this, the exposures were pretty minimal, and part because of the OCC rules that we've been mentioning, that a lot of banks in our district had been sort of holding, being more conservative in sort of their participation, and in some cases no longer participating in the energy sector. So we saw that happen. I don't have any up-to-date banking statistics. Unfortunately, that stuff comes with a significant lag. There's a huge firewall between the private banking data and the economists. So we'll have some updated data on that in about a month and a half. We'll get a better picture of what the banking sector looks like. But we were pretty well positioned coming into this. So I don't see a lot of distress or too much distress for many banks in the banking sector here. But like as I said, they were less apt to be participating in the first place because of these requirements from the OCC and others.
That's helpful. So let's shift now from thinking about folks that are tightening credit to folks that might have capital availability. And let's talk about private equity. I mean, Brian, talk to us a little bit about how private equity firms are going to act in this environment, both with their existing portfolio companies and then with dry powder.
Yep, no, great question. So private equity is not insulated. There's no doubt private equity is hurting, but I would say the pain infliction on private equity varies greatly depending on the size of the private equity group and what their overall investment strategy is. So for example, let's talk about the larger multi-billion-dollar private equity groups that focus on upstream. Right now, most of those are focusing on what's referred to as smash transactions, where they're taking their portfolio companies and smashing them together in consolidations. This is a pretty solid strategy in that it does alleviate some decent amount of overhead because you can curtail employees and get economies of scale. That strategy also puts a lot of pressure on management, which now has reduced their overall payroll and headcount, yet drastically increased the asset size. So with the larger private equity groups, they're mostly surviving through a focus of reduction of cost right now, consolidations, and really tightening the belt, if you will. The funds that are really in the most world of hurt are going to be those that are near exit. So those funds that have, say, been around, had in their documents a life cycle of, say, 9 years. Well, if they're at the period of exit, they're in a tough spot, because the reality is there's not a good market for them to sell those oil and gas assets, especially at anything that is worth anything to their investor base. And so what you're seeing with those funds is most are going back to their investors trying to get extensions of those funds, so that ideally they can kick the can down 2 to 3 years and sell those assets, and ideally when the market turns around. There are other funds that are, I wouldn't say giddy in this market, but they do view it as a period of opportunity. They do have dry powder, as you mentioned, Dan, and so for them, they're on the market looking for assets. The ideals of buying cheap assets, those assets that are from companies that are about to go bankrupt, obviously puts a smile on some of the private equity groups. But the challenge with that, Dan, is that right now there's just no market to sell. Companies are not going to want to let go of those assets in this kind of market unless they're forced to through a bank situation or near bankruptcy. And so, to directly answer your question, we're seeing pain infliction on the whole chain of private equity, but a lot of it just depends on the size of the private equity. If it's a more mature versus a younger fund with a lot of dry powder that is looking to invest. We are also seeing some funds look deeper into their offering documents, especially the upstream side, to determine if legally they have the option to diversify their investment platform. And instead of focusing just on upstream, can they get into, say, terminals or storage? Because now all of a sudden they're viewing that as maybe a more viable option long term with what we've seen. So we're seeing a different strategy shift as well as these private equity groups look to survive. But to answer your question, I definitely think private equity is going to have a looser on the purse strings as opposed to banks. But that being said, I still think it's going to be a tough market. They're not readily available. That cash is not going to be readily available. There has to be a significant value prop with these management teams for a private equity to loosen the purse strings.
Thanks. Anas, as you look around kind of globally, is there going to be enough capital for energy companies to do what they need to do? How are these companies, how are the international companies going to come up with money, or are they just going to trim their budgets down to where they're spending within cash flow, or will they seek external financing or try to sell things? And who do you see as buyers of assets in this market?
Sure. I just would like to go to a couple of points in the previous segment. Basically, the first one is we are seeing foreign investors basically shopping in the United States right now. And the problem with that is the emotions in the shale patch right now is very raw. And that might create a backlash. So yes, we need the money, we need the investment. But think about it, if you have Chinese companies buying shale or some OPEC members basically coming to buy shale, I think that's going to cause an uproar in several quarters in the United States. So yes, we need the money, but that might cause a problem. Foreigners basically buying assets after everything we've seen in the last 2 months. So that's point number one.
But before you go on from point number one, sorry to interrupt, but
no,
are the Chinese and Middle East actually shopping now, or you think they might?
Yes,
I think they are shopping.
Absolutely are.
Ryan says they are. Anas?
Yes.
Yes, they are shopping right now, and there are several groups, even from Latin America, are shopping. Everyone is looking at this as a great opportunity, but I think there could be a big backlash against it, especially if the investment is large enough. Let's remember that Unocal in Indonesia years ago, when the Chinese tried to buy the company, and all of a sudden Unocal became a national security issue.
Yeah.
So I think we might see a backlash. The other thing related to the previous segment basically is this. Any government policy, and for industry leaders, they should not only focus on what we are in right now to solve the problem. They should focus on the results too, and what's going to happen next year and the following year to be able really to solve the issue in a perfect way. Here is why. Just to give you an example. In 2015, when the market crashed, students in petroleum engineering departments at some universities just walked out and never came back to class. Classes were completely empty. And chairman and deans basically were calling them on their cell phones, begging them to come back to class. That tells you what's going to happen next, that those students who are at some universities right now are really rethinking their choices. And therefore, when we go for the next segment of the industry right now, we are going to have those shortages and problems. And if the government is really serious about helping the industry, get this one. There are certain petroleum engineering departments for masters and PhD. Every single student in them is a foreign student. There is not a single US citizen in those departments right now. What that means is the industry and the government should really work on some formula to be able to keep those students in the United States when they graduate, because we really need them in the next 2 years. To go back to the money and the international oil companies, I think for the oil majors, yes, they are hurting right now, but when they look at the next 15 and 20 years, I hate to say this, but I think they are very happy. And they are looking at great opportunities in various ways in this case. And some companies, they already have some cash on the side anyway. And it's not only an opportunity to buy what they wanted, but it is a great opportunity, especially for the national oil companies, to expand capacity right now. If you look at Saudi Arabia, for example, Saudi Aramco, they are expanding capacity by 1 million barrels a day from 12 million to 13 million this year. And everything is so cheap in the service sector right now, they can expand that capacity at a very, very low cost.
Interesting. So I want to come back to this issue of the international companies shopping around in the U.S. So, Brian, you jumped in and like people are definitely shopping. Talk to us a little bit about that. Are we talking about $50 million transactions or $500 million transactions? I mean, are guys bringing big checkbooks, little checkbooks? Yeah. And that's going to lead to a consolidation question that I'm going to ask the whole panel.
Yep. No, we have seen a massive influx really over the last 2 years, but we have seen over the last month an increase from China. Specifically, recently, I worked on a $3 billion deal out of China. So we're seeing some decent size opportunities. And frankly, a lot of the, I would say, newer funds, we're seeing significant investments directly into the funds from China as well. So we're seeing investments directly into private equity as well as directly buying assets. And I would say that trend, we saw that trend probably start about 3 years ago, but there is a lot of talk around the water cooler with a lot of our foreign affiliates in China that this is a hot area. This is a massively hot area.
Oil assets or gas assets or both?
Oil assets. They view it as an opportunity to buy more real assets in the United States.
Interesting. Buddy, are you seeing anything like that?
Say that again, Dan. I'm sorry.
Yeah, I'm sorry. I was just asking if Buddy had seen the same thing in from the legal practice side. And Bud
worked on a BPX by a German fund that closed about a month ago, and we've also had some inquiries from national oil companies down in South America about looking for U.S. assets. So I think there's that opportunity there for people with cash to buy up some assets, whether they be foreign or domestic. Dan, we saw in the late 90s a lot of consolidation, even at the major level. Exxon, Amoco, Texaco, Chevron. And I'm not saying we'll see it at that level, but I do think, I agree with the panelists that the majors have a real opportunity to here consolidate positions, because a lot of these producers just aren't going to be able to withstand the lower prices for very long.
Do you sense, Buddy, that folks?
Just wanted to add one more point. Your question about bankruptcy, our bankruptcy partners are expecting that we're going to see a lot more sales through the bankruptcy process this time around. And in 2015, 2016, you saw a lot of reorganizations where the debt exchanged for equity, and they came out basically with new management or the same management, pretty much the same company. But our bankruptcy practitioners are expecting to see more just outright sales or even Chapter 7 liquidations.
Interesting. So, and that's a function of the creditors unwilling to go for another round. So they're basically saying, forget business as normal, sell these assets, or is that gonna happen immediately or over a period of a couple of years?
Well, I think to the extent it happens in the bankruptcy process, it happens in the next couple of months. And it would be an expectation by those people that are holding the debt that they're not going to see repayment anytime soon. So they might as well just cut their losses now and get out. And then also some of these properties may not be economic even once we get out of this downturn. And if they're not economic, why would you continue to hold on to them and pay for maintenance cost or be stuck with the P&A cost? So I do think there are opportunities for people that are, looking for the bottom end of the market. And there's a lot of that may be where the small producers play for the next couple of years. They buy up the small properties and hold on to them. There's a great example of what Brian was talking about, the private equity company Smashco's. In the 90s, late 90s, NCAP bankrolled Frank Lazinski on a company called AROC. And AROC went through a number of iterations. It's now called Earthstone. And they're calling us saying, look, we have tons of money. Give us a call where the opportunities are. So that's an example where a Smashco from 20 years ago is now a strong, profitable company. So we're not talking about the end of the industry. We're just talking about transformation in the industry.
Let's talk about the consolidation again, or come back to it. So do you think that in today's environment, and this is a question for the panels, but Buddy, you answer first, these distressed companies where debt is trading fairly cheaply, I've heard some folks say, well, it's hard to do a consolidation with public companies that have public debt because the make-whole clauses in the debt would say if Company A buys Company B, Company B's debt has to be paid off at 100 cents and it's trading at 20 cents. So how does consolidation happen when you've got these kind of outstanding debt issues?
Yeah, I don't think it's going to be an easy exercise out of a bankruptcy process. Within bankruptcy, it's pretty much a cram down, and so the fulcrum debt will be able to call the shots. But on the larger consolidations, it's going to be a lot of work for the lawyers and accountants.
Yeah. Brian, do you see public to public, or do you see this as mostly being a private company type of process? Is it going to be privates consolidating or public's going to consolidate too?
I think it's going to be both. I think we're going to see, as we've alluded to before, the Smashcos, which started the private equity level and are easy for those private equities to do because those are portfolio companies that they control already. So I think you see a lot of that. The public side is obviously more difficult because of the regulatory environment, right? As Buddy said, you got a lot of legal, a lot of accounting costs, a lot more work that has to take place. But I think the natural tendency we're going to see here over the year is I think we're going to see some of the independents come together and possibly some of the independents even get sucked up by the majors.
Anas, give us your view here. Consolidation, do the majors, do they jump in 2020? Do they wait to 2021? Do they wait to 2022? What's going to be the trigger for the guys who have the dollars to come in and do something?
There are two issues here. The first one is valuations are very low, which means that if I own something and I can survive, I will not sell no matter what, because I know that what I have worth more. And we've seen this in 2015 and 16, because of low valuation, basically companies refuse to sell. But on the other side, if you look at the historical patterns, all those consolidations happened once we pass the bottom. So once we are going upwards, that's where we see it. We are not going to see it on the downward trend or at the bottom. We need to see some, like, if you want to call it, a green shoots for people to move in. But I would like to mention one more point relative to what I mentioned earlier, that if you look at private equity, for example, companies that's been there for 20 and 30 years and they never had a fund that failed. If we have a fund failure right now, that's going to cause a major issue with investors basically putting money into private equity. Mm-hmm. Just a single failure. I'm talking about like the big ones. I'm not talking about the small ones. That's number one. We also have seen a change in the makeup of investors in recent years. So the old investors who've been faithful investors, they are getting out of investing in private equity that is focused on the sector. We have new investors coming in, and we have international investors coming in, and we have the national wealth funds now jumping on the wagon too. So if you look at what some, like, I know you all know that Norway basically is trying to shy away from investing in oil. But if you look at others, like in the Gulf, like the United Arab Emirates or Qatar, they've been jumping on the wagon, and they invested heavily in those funds.
Interesting. I want to circle back to something we talked about with. Oh, go ahead, Brian.
I had one thought on that as well. Dr. Alhajji, I mean, he kind of hit the nail on the head on that. You know, when we talk in generalities around private equity and dry powder, and that money is going to be there. But the reality is that all comes back down to the initial investors, which are mostly larger institutions, could be domestic, could be international. And what we've seen over the last couple of years is, I wouldn't say a curtailing of those investment dollars, but we have seen a big push on ESG and what are these oil and gas companies doing in regards to their ESG standards. That being said, we haven't necessarily seen a drawback of the money because the returns have been there. Now we're in a situation where the returns aren't there, and you still have the overriding ESG issues. So I do think it is a risk. As we look over the next year, we could start seeing a curtailing of those investment dollars from the institutions coming into private equity, which effectively would cut the flow of those dollars going down to the portfolio and the direct investments into the ground.
I think that's a great point, Brian. One of the things I worry about around private equity is just the fact that we've seen the public valuations compress dramatically. PE valuations move slower, but are probably trending down. And so those institutional investors are going to see a fair bit of compression of their returns or multiples. They thought they had something worth 1.5x and it turns into 1.2x or 1.0 or 0.7 or whatever. So that probably doesn't encourage them to put more dollars to work.
Dan, may I add one point, please?
Sure, of course.
Sure. What we've seen in private equity basically is this, that historically we have private equity that's been in the business for 20 and 30 years with a very impressive experience in the sector. But with the shale booming in 2013 and 14, all of a sudden we've seen new money coming in with no experience. And that kind of caused several problems to the sector. So the idea here is if we are going to drive away this type of money, probably this is good for the sector.
If we're going to drive away this type of meaning we're going to have more experienced people, we may have less capital, but if we've got less capital, that means things tighten up and we've got better returns for the capital that does get deployed.
Correct, because one of the issues that we had in 2015 was all those funds, the new funds that came in, new guys came in with no experience in the oil sector, they got burnt in 2015 and give the industry a bad name.
Yeah.
Because they did not have that experience.
Right. Nope. Great point. Want to circle back to a question that popped into my head, and I think one of our listeners also sent in to Mark, which is back to this issue of how banks are acting. And, I think, Buddy, you talked about banks are hopefully looking for some regulatory relief so they can be a little bit more accommodating. We've seen some press about banks actually getting ready to create operating divisions and operate assets if they've got to take them over from their clients. Do you believe that, or do you think that if a bank winds up with energy assets, they'll sell them like they've done historically?
Well, you're referring to that Reuters article that came out 2 Fridays ago. And in fact, the reporter called me up to ask me my thoughts about it. At the time, I have not heard of any banks that have purposely set up special purpose entities to acquire oil and gas assets or to convert their collateral into other real estate owned assets, which banks can do. And it's a tool that banks have, and they need to keep that in their quiver. But my experience has been that banks are not really enthusiastic at becoming oil and gas companies. And there's a couple of reasons for that. Most of these credit facilities are not single bank, single producer, or single well deals. We're talking about multiple wells, multiple leases, and the producer probably has a bank group of 5 to 10 different banks with different ownership interests. So just as if you would, as a producer, not welcome the idea of having 10 different private equity owners telling you how to run your business, it becomes inefficient. I think you have too many cooks in the kitchen, and none of those cooks in this metaphor really want to add any more money into the pot. One thing that Joe Bridges told me a couple of years ago is the oil and gas industry is always out of money. It just inhales capital. And for a banker to tell its credit officer or its board of directors, hey, we need a couple more $1 million for this investment we just took over to keep it afloat or to plug some wells that are no longer economic. I don't see the bankers wanting to have that conversation. What I do hear, Dan, and I think this is more plausible, is that the banks would essentially take over control of a producer, but not take title to the producer. And through exercising their remedies of controlling voting rights under pledges of equity, they may bring in a new management team or bring in a private equity team that's willing to infuse more capital with the preferred equity structure, so that if and when the markets turn around, the private equity company gets paid back, but more importantly, the banks maintain their ability and possibility to recover the principal that they've loaned to that company. So I think it'd be more of a partnership between a bank group and a private equity fund coming in and maybe a new management company. But at the end of the day, no matter what you do above ground, you got to deal with the same rocks that you were dealt with. And if they're bad rocks, they're bad rocks.
Yeah. Dan, can I add on that as well?
Please. Yep.
Yeah. So we, I agree with Buddy. I mean, I've heard for the last, I don't know how many years, that the larger banks are going to create their own fund, and effectively when they foreclose on assets, that's going to come into their funds, their SPVs, and that's what how they'll manage those assets. I have yet to ever see that take place. I hear different rumors, and banks just don't want to do that. So like, for example, our firm, we actually have a significant bank consulting practice, and we work with numerous banks that loan to oil and gas. And right now, a lot of those banks are reaching out to us to assist them in working with management teams, looking at how can we sharpen the pencils, come in and assist with, be kind of the liaison, if you will, between the bank and the group to get the ship as best as possible going in the right direction. I think you're going to see more of that. As opposed to these banks, foreclosing on assets. That's just not what they want to do. They're going to try to avoid that with everything they can. But I do think they're going to they're obviously going to tighten the belt. They're going to start having a more active role in the governance of these organizations. And our firm is actually starting to see that right now as the banks are reaching out to our bank consulting arm to come in and work with these oil and gas groups.
So I think if I restated what I heard from you guys, the banks don't want to be operating companies, but they may want to exert more influence and control, and they're getting ready to figure out how workouts, if you will, need to kind of be put in place.
Yep. Yeah, that's my thinking. Yep.
Okay, got it. Excuse me. So we spent a lot of time talking about upstream. Other segments of the industry, midstream, refining. How are the midstream companies? There's always a lot of discussion about distress. When you get distress in the oil patch, everybody tries to recut contracts. So I'd ask the group, how are we thinking about things like LNG contracts and take or pay contracts, and are we going to see renegotiations? Are people going to break those contracts? Are we going to force majeure, or can we force majeure LNG exports? How do you guys think about those issues? And raise your hand if you want to go first, so I can. Nobody wants to go first. Anas says he wants to go first. Awesome. You're muted. Anas, you're muted.
When we look at U.S. LNG exports, we have two issues here. As you all know, that the U.S. LNG is priced off Henry Hub. The problem with that is we have the take or pay, and when it goes to India or goes to Asia, then it will meet the other LNG coming from other countries that priced off oil at $10 and $15 and $20, which is extremely cheap. That's one side. The other side is because of the lockdown, the demand in those countries declines substantially. So you have a decline in demand on one side, you have a decline in oil prices, which led to a decline in LNG prices on the other. So whatever you do, it's a global problem. It's not only a US LNG problem. And since it is a global problem, you cannot really help your own industry alone without others basically participating in it, just like the OPEC Plus in the oil market, for example. So we have a serious problem there. But luckily, on the other side, luckily for the LNG industry, of course, that natural gas prices in the United States collapsed. And that will help on the cost side of the LNG. On the other side, we've seen companies basically literally going for the force majeure, but on the consumption side, not on the production side, which is kind of very interesting because they don't want to receive it. However, some people think, and there is some truth to that some countries in Asia played the game to get the lower price because they have the contracted price and you have the spot price, and the difference between them was several dollars. But if they use force majeure, basically, they can literally force the other side to renegotiate and accept a lower price that is closer to the spot price. So there are some evidence to show that it was a game they played to lower LNG prices.
Dan, I think you're on mute.
Dan, you're on mute.
Oops, I was the one muted that time. Thank you. On the midstream side, do we think that there's a lot of case law back and forth around breaking contracts when a producer goes into bankruptcy. Where do you think that shakes out as it relates to Texas and a bunch of the midstream stuff here?
I assume that's a question for the lawyer, Dan.
That is a question for the lawyer. Thanks.
It's, it's an interesting question. I have some personal thoughts about it, which I'll try to refrain from venting. But this came about in the earlier bankruptcies with the Sabine case, in which the producer challenged certain midstream contracts as being executory, and so it could be rejected in the bankruptcy process. And the midstream companies wanted to assert that they were not rejectable because they actually created covenants running with the land. So not to get too detailed about the legal issues, the judge in New York, pursuant to the way the case was argued before her, determined that they were contracts that could be rejected. That pretty much shocked the midstream industry. And I think that the decision was probably incorrect, although the effect of it for Sabine was not that major because they were not utilizing those midstream contracts. They had other ways to get their production to the market. Most producers usually have one exit from the field, one midstream contract. So if they reject it, all they're trying to do is initiate some negotiation over prices. But whether they can reject it or not is a state law issue that the bankruptcy court would have to apply. And we've seen in cases out of Colorado applying Utah law, and as well in the Alta Mesa case here in Houston applying Oklahoma law, that these later judges have found that the contracts are not rejectable. In fact, Judge Jones, I think during the Lynn bankruptcy, said out loud, I sure hope somebody raises that issue before me so I can set the record straight. I think on balance, most of these contracts are not going to be rejectable to the extent they contain the magic language that dedicate the reserves in the ground exclusively to that midstream gatherer. That's going to happen in cases, Dan, where the midstream company built the line out to that producer exclusively for their production and they want to recover their cost of investment. And so they locked it in. To the extent Exxon's out in the Permian and some gatherer says, we'd like to take your gas. Well, that's a spot gathering contract. So those would be rejectable. You need to look at the nature of the contract, but for most of the ones where there's dedication language, I think that the midstream producers are going to prevail. That doesn't mean that they'll come out unscathed, because if the producer goes through bankruptcy, as long as they're going to continue to produce and flow product through those lines, the midstream gatherers will get their toll or tariffs. But if the producers shut in, the midstreams don't have much recourse there.
Thank you. Let's talk a little bit about natural gas. So maybe Jesse, if I could bring you back in. You talked a lot about oil and what's going on in the oil markets. Are we more bullish about gas? Should we be more bullish about gas? And then I'll come back and ask the other panelists that same question.
So there's a lot of associated gas coming out of the oil wells. And so if we curtail oil production, particularly the shut-ins, which, we're currently expecting about 2 million barrels a day of shut-ins in the United States, you're going to see that associated gas fall off. And that is going to put some upward pressure, we think, on natural gas liquids prices. So, a lot of the associated gas is very hot in shale plays and the oil shale plays. So the LPG market could see a little bit of tightening. But when you look at the volumes that are going to be required to come off, I don't think we should expect the market to be a bonanza. I think we should maybe see some firming prices, but it's not going to be as if the shale revolution never happened. Firmer than where we are, but probably not an earth-shattering spike in prices.
So with that, Jesse, do we assume then that natural gas demand is going to be okay? Power demand, for instance. So that's, that to me, the question has been LNG exports and the recovery in consumption. So your view is consumption is going to be okay on the gas side?
On the gas side, I think consumption is going to be okay in the short term. It's down a little bit because we've shut down industry, but we've already seen, for example, some green shoots of industrial activity in China, with things firming up a little bit there. We're going to see the same thing happen in the United States here in the coming months, and so the industrial demand will come back. The power sector is holding up okay. I mean, it's like I said earlier, it's down a little bit in the United States. We expect it to be down a little bit elsewhere in the world, but natural gas generation outlook is pretty firm.
Okay, Anas, what's your view on gas?
Will we see higher prices than today because of the shut-ins? Definitely, yes. But we have a ceiling, and that ceiling is relatively low. Here is why. If natural gas prices keep going up, let's say we will go to 340, 350, 360, 380, at that range, we are going to see the power sector unwinding switching. So we might lose about 4 to 6 BCF a day as the power sector basically switch back to coal. That 4 to 6 BCF a day basically is enough to put a ceiling on natural gas. But let's say the shut-ins is so large that the impact is large and prices keep going up. Once we hit $4, $4.10, Alberta has about 2 BCF a day to dump on the United States. So all of a sudden now we have about probably 6 to 8 BCF a day being dumped on the market. And let's say that the shut-in impact is larger, so natural gas prices keep going up. We are at 5 or 550 or higher. All of a sudden, all that extra non-contracted LNG is not competitive anymore. So the contracted, where we have the contract take or pay, is going to be sold no matter what. But the non-contracted LNG basically is going to be backed out. And that's going to back out the pipelines all the way to the well. And that could add probably another 2 BCF to 3 BCF. And at the same time, it might delay some future projects that are being built right now. So in a sense, yes, we will have higher prices, but within a certain range, and that's it.
Thank you. I think there are a number of players that would be thrilled to see 350 gas, much less 450 or 550. We're getting close to the end of our formal panel, and then we're going to take some questions. We're going to have Mark moderate that session, or at least feed the questions to us. But you guys know, and I prepped you, that I like to do this sort of rapid fire, what's your opinion on certain things? And so I'm going to ask a series of yes or no questions, or questions that require just a specific answer. So I don't need any detail on it. I just want everybody to kind of encapsulate their viewpoint. And so I'm going to ask each of you to respond. So the first question is, end of 2020, oil prices greater than $30 a barrel. Anas, we'll start with you.
Yes.
Yes or no? Yes.
Yes.
Buddy?
Yes.
Jesse?
Yes.
Brian?
Yes.
Dan says no. End of 2021, oil prices greater than 40. Buddy?
Yes.
Jesse?
Yes.
Brian?
No.
Anas?
Way higher than 40.
Yes, yes. Two
Yes.
yeses. And I'm going to say no also. Natural gas, greater than $2, end of 2020. Jesse?
I'll say yes.
Brian?
Yes.
Okay. Anas?
Yes.
Buddy?
Can I say I don't know?
Sure. No answer. And I'm going to say yes also. Now, 2021, end of 2021, 250 is the number. Brian, we'll start with you.
No.
Jesse?
I'll vote no.
Buddy, I'm going to give you a don't know. Anas?
Yes. I am a yes man today.
There we go. You were a yes so far, and I'm going to say no. Tomorrow, the Texas Railroad Commission talks about prorationing. Will we proration in Texas either tomorrow or at some point in 2020 or 2021? Buddy?
No.
Jesse?
No.
Brian?
No.
I say no. Anas?
No, and I'd like to refer people to my article, 2 articles in the Forbes and the Oklahoman on this.
Great. And can we Google your name to get there, or?
Yes.
Okay.
Yes.
And so more information there. Next question, will the OPEC Plus cut, which is headline 9.7 million barrels a day, when we add it all up, will that cut be more or less than 8 million barrels a day? So headline's 9.7, I'm setting the over under at 8. Anas, over or under 8 physical barrels cut?
Over.
Jesse?
Less, unless they go beyond the agreement.
Okay. Brian?
Say less.
Under. Buddy?
Over.
I'm actually going to say over as well. Last question. Do you think that the government is going to provide equity capital, not loans, but equity capital to U.S. energy companies during 2020 or 2021? Buddy?
I would hope not.
Okay. Jesse?
No comment.
No. As a part of the government, I'll take that answer. Brian?
Absolutely not.
No. Anas?
No answer. I don't know.
Okay. You get a don't know. And I'm going to say I don't think they will. All right. It is 8:33. I ran over a little bit on our panel. Mark, you've been collecting questions. Would you mind to come back and basically give the panel sort of the best questions that you received? This is the equivalent of people raising their hand now and asking the panelists questions. So can you come back on and let us know what people are asking?
Yes, and thank you guys for your wonderful panel sessions. Been getting some great comments on the side. And so, folks, we actually have a chat on the side of our teams. Most people are kind of not using it. Most people, some are. So if you look at your screen, you should see a button next to the phone, next to the 2 people. It's hide or bring up conversation. So, all right. So let's see. So from Roger Andreco, hopefully I said that correctly. For private equities that have dry powder, is there a concern or issue for LPs that have committed to a fund to come to the table with cash when there is a cash call to finance an asset?
So basically the question is, do we think that institutions will default on their capital calls?
Yeah.
Brian?
Yeah, there's always a possibility. So yes. Do I think we'll see much of that? No. Generally, institutions are pretty reliable. Once they sign they sign the documents, they get a capital call. It is extremely rare for them to go in default. So is it possible? Yes. Do I think we're actually going to see much of that? No, I don't.
One of the things we saw in 2008 and 2009 when private equity ballooned as a percent of institutional portfolios because the market tanked. And so you saw private equity as a percent of the total go way up because the marks didn't come down. What you saw in that environment was the institutions really leaned on folks and said now would not be a great time to make a capital call. And so the pressure they apply is basically if you want me in your next fund, you're not going to send me a capital call in the next 6 months or something like that. So you could potentially see that this go round, but I agree with Brian. Usually these guys, I mean, if you send them a capital call, they fund it.
Anyone else? Okay, perfect. And so this question came in the chat, and Jesse did answer it in the chat, but this is from Deb Lynch. Does the Fed maintain any metrics on carbon emissions?
So yeah, the Fed does not maintain any metrics. We rely on the IEA or the EIA. Actually has some really nice statistics that they pulled together now, as well as the EPA. There are a number of entities out there trying to measure carbon emissions from a variety of sectors. The holistic calculations are not maintained in real time, but you can go on sector by sector and you can say, well, this is what we know about carbon emissions from typical diesel consumption in the commercial sector, or what does your average vehicle mile generate in terms of emissions for cars, and then you can do an estimation right there. Where I got a little bit creative last year is that we had to look at some satellite data to try and figure out get a real handle on what exactly were the emissions from flaring. And they were pretty significant in terms of the contribution of flaring to carbon emissions. What we know that with consumption off by about half, off by about a quarter across liquids, that carbon emissions are probably going to be down commensurately. Energy consumption accounts for just hydrocarbon fuels. Accounts for a good portion, something like 80% by mass of the CO2 of the net CO2 emissions on a carbon equivalent basis. So you can get a pretty good idea of the trajectory just looking at energy consumption data.
Thank you, Jesse. This question is from Andy Wong. Why would OPEC nations continue to produce if storage is at or near full? A, who is buying? B, and what does this mean for US oil producers? Do you see many bankruptcies to eliminate domestic competition?
I think that's a good and honest question, huh? Why wouldn't the OPEC countries cut more?
Man, all right. Should I take that one?
You should, Anas.
All right. First, let me state this. I seriously think that after what happened on March 6th, when the Russians walked out of that meeting and the Saudis reacted to it, and all the damage that happened after that, and then we had the full impact of the COVID-19 basically worldwide. It is not in the interest, in my view, of Saudi Arabia to cut production at all. Those countries, if you look at Saudi Arabia and Russia and the larger countries, they've been trying for 5 years of meetings and cuts to support prices, and they couldn't. So this is, in a sense, a golden opportunity for them to just go for it and slim the non-OPEC production, whether shale or others, and bring market to balance so they can manage it after that. So in a sense, it's not in their interest to cut production in the first place if you really think about it in the long run. By the way, those countries do not look at it in terms of month and two, despite the financial pressure. Those guys are looking at the long term. In fact, if you look at how they are reacting to all the hype in the market, whether it's about shale or electric vehicles or others, those guys are talking about oil to materials. Why they are talking about oil to materials? Because they want to preserve demand, which means that if you don't want my oil, I will export it to you under a different form. But what if we still need that oil in the future? So I don't see that they really need to cut more. I think it's their interest just to what they did is, if you look at it, yes, they committed themselves to the cut because of political pressure, but look at the OSP prices. They've been giving massive discount. What that means? It means that the competition is going on, and they realize that it is in their interest to maintain lower prices for longer.
Any other input on the question? Perfect. This is from Don McCormack. He's asking, do you assume that US producers won't shut in new prolific wells? Do you assume that it will shut in older wells?
I'll take a stab, and then some others can talk as well. I think that I've talked to a number of private companies. I think that I view the privates as the purest voice on this, because they're not trying to protect the share price. They're trying to make money. That's it. And so talk to privates in the DJ Basin, in Oklahoma, in the Eagle Ford, in the Permian. And you got guys that are 50 to 100% shut in. And that's horizontal. That's new stuff, old stuff. If you're not making money, you turn it off. And I think in some instances, the horizontals are viewed as maybe less risky to shut in, because the ability to bring them back and not lose production or risk the return of production is actually lower than some of this their other assets. So I think you're going to see horizontals and high rate wells shut in. And the other shut in that's happening is duck builds. Guys are not completing wells because you don't want to sell that flush production into a $7 cash market. So I think that the high rate shale wells are going to be definitely included in the shut-ins.
Yeah, absolutely. It's not, there are midstream logistics here, with storage and transport capacity that are a factor. You've got hub pricing at, in Cushing, but then you've got, Midland pricing, and then you've got your wellhead prices, and then in many cases much lower. It's not a question of what is the lowest productivity well that I can shut in to, or lowest profitability well. It's I have to shut in production wherever I'm forced to. And we're seeing this, that it's not just an economical, what's the least economical well or the most economical well to shut in. It's logistically, I have to shut in good wells. I've got to shut in old wells. It's wherever it has to be shut in is it's being shut in. And that's happening in the upstream. And even in terms of unit utilization on the downstream sector, you're seeing the same thing where it's not just about economics. It's just there are some physical, logistical constraints on what it is you're having to shut down.
I'd like to add something, if I could, on the legal perspective. What we're seeing, some of our producers, they're not shutting in 100%. They're cycling their wells within the field, perhaps for engineering reasons. But from the legal perspective, there's a lot of contractual obligations that producers have. One, to continuously produce oil and gas from the wells in order to hold the leases. And then they have obligations downstream with respect to their gatherers and other contracts. So it's a very complicated issue to address. It's not just a price equals cost of production. It's engineering, and it's also legal issues. And it's this is unprecedented, at least in my career for 40 years. We were talking to bankers just yesterday where a producer wants to shut in production through the end of the year, layer on some offsetting hedges, and not produce anything more. Credit agreements are not set up for a producer to say, I'm going to take a holiday for the rest of the year. There's a lot of issues that have to be looked at, and that's just on the banking side, but on the leasing side, it's a very complicated question.
Anas?
Yes, just one comment. I agree with everything that's been said. Just one comment. If storage is full and pipelines are full, it doesn't matter because you are going to close all the wells no matter what.
Thank you. And so this question comes from Rob Basher, and I'll probably add Carlos de Silva. So Carlos is asking, are we expecting a rise in M&A activity? I think we touched on it, and then Rob Basher would appreciate the thoughts on the panelists on consolidation of upstream companies.
Yeah, I mean, I can add.
I'll say something about consolidation. We're going to see it. I really liked, I can't remember, I think Anas said the consolidation comes when things are getting better. The strong hands are going to wait for really cheap prices, and they're going to wait to feel better. And why do they need to do anything in an environment where everybody's sort of waiting and pausing and thinking things are going to get cheaper? And so I think the first one of these deals that goes for good assets, you'll see 6 of them because everybody's saying, I don't need to do it now. It's going to get cheaper. And when the fear that it's not going to be cheaper or it's going to get away from them happens, that probably means things have ticked up. And then you're going to see the feeding frenzy from all of the strong players. So I don't really think, I think it's desperation consolidation over the next 6 to 9 months, and then it's consolidation of strength after that as the uptick starts.
Yeah, I would agree. I don't think we're going to see a lot of M&A over the next couple months because companies are going to do everything they can to avoid that. They do not want to let go of those assets. They're going to, if they do, it's going to be at a very poor price. So we're just not going to see a lot of activity. We will hit a point in the coming year that we will start to see that trend. And as Dan mentioned, I think it'll go fast. I think we'll start to see a couple, and then we'll start to see a flurry of that. But it's very short term, the next couple of months, I don't think we're going to see a lot of M&A.
Brian, I'd be interested to hear what you are seeing on the accounting side. One issue that we're seeing from the bank lending side is producers unable to deliver clean audited letters because they're having difficulty evaluating what their total assets are worth in today's market. It's so broken.
That's right. So as auditors, there are a couple of key things that come into play. You have impairment of assets, but more importantly, you have the going concern rule. Will the company survive for a year post the opinion date? So let's say, for example, an auditor opinion is rendered in March of 2020. You effectively have to give assurance through March of 2021. Well, these are unprecedented times. Management tries to look into that crystal ball, but and prove to the auditors that indeed they have a justification the company will survive. That's a very challenging endeavor. And the banks don't like going concern opinions. The auditors certainly don't like giving them, but the auditors are constrained by their own regulatory environment. And so what you're seeing is, Buddy, to your point, you're seeing sometimes where auditors are literally getting financial statements right to the point of issuance and just flat out not issuing the report. The banks are saying, let's just wait. Let's kick this can down the road before you render a final opinion to avoid a going concern. Let us work through our redeterminations. Let us give additional assurance to you as the auditor so that then you can render a clean opinion. So it is causing a lot of havoc. That's actually a great question. I would say for most of our engagements, we've seen an increase of probably 15 to 20% of time, professional time, around those two issues, impairment and going concern alone.
Go ahead, Dr. Anas. Were you going to say something?
No.
Okay. So just to let the audience know, we were going to do a hard stop at 9 a.m. But because of the conversation, we believe that some individuals definitely want to hear some things, and the conversation is going to continue a little past 9 a.m. Obviously, if you have something more important to do, go ahead and leave. I don't know what's more important than this conversation right here, right now, though. Okay, perfect. Super. So let's see. So we have a question from Rex Holmes. Companies are, of course, revising their capital budgets and expenditures. Are there any macro level estimates of what 2020 will look like compared to 2019? Percentage decrease, for example, and what could we expect for 2021?
There's a couple of entities that have tracked this, and we try to keep track of announced CapEx cuts. CapEx budgets were already going to be down a bit year over year before any of this happened with the coronavirus. And then companies have revised and then revised again, in some cases, their outlook for capital expenditures this year. So if you're asking me this about 3 weeks ago, I would have said we were thinking something on the order of 40% year over year cut in real CapEx. And it's probably going to be north of 50% when the final analysis is done, possibly. And that would be a sort of a base case as of a week or two ago. If this weakness persists, you'll see more downward revisions. So in terms of real CapEx, that would be a cut of about of over 50% is probable. And that has significant implications for GDP, although everything in GDP is going to look pretty rough here the next 2 quarters.
I think we're going to see an ongoing sort of death by 1,000 cuts. We've seen a number of companies that are announcing their Q1 earnings and delivering their 3rd adjustment to CapEx. I just really struggle. Going back to the private company analogy, private companies are shutting in almost all their production and taking their drilling rig count to 0. And so the publics will follow that directionally. They're slower to act and they've got more sort of appearances to keep up. But the pressure is absolutely down on CapEx. So the revisions, I think, was what Jesse was saying, are absolutely going to be to the downside. I think rig count's going to 200 or 300, maybe closer to 200 than 300. And 2021 really depends on oil price. And, we had some overs and some unders on our oil price expectations. Folks I've heard say they don't really want to turn production back on until oil's 30. And at 30 or 35, the cash flows that you've got are just not going to be much to support overall drilling activity. So I think 21 budgets could actually be down because you got a whole quarter of pretty good prices this year, and you may have less cash flow next year, and certainly more concern. So I'm not optimistic about 21 budgets. Maybe they're flat, but it's not going to be great.
Dan, one of the most interesting comments I heard recently from a couple of public companies, from the board of those companies, that they are looking at their budgets in the coming years. And their view is what happened between Saudi Arabia and Russia on March 6th might happen at any time. And therefore, they are going to plan their budgets with the assumption that will happen again.
Yeah.
Excellent. I had wanted to add one point. I think I had this slide in my presentation at the last FANG event in January. But when we asked oil companies what price of WTI, we have our big energy survey, and it's both public and private companies, mostly private, mostly small. What price of WTI do you need in order to fund your planned CapEx for the year? At that point, they were saying they needed, close to $50, for over half of them to be able to fund their CapEx out of cash flow. And so while, oil field service costs are certainly down from where they were, they're not down at a sustainable place. And I don't think that's a number that's going to come down a lot this year or next year. So I think we're going to need to that point, I think we're going to need to see some substantial recovery in crude oil prices before companies have any type of meaningful cash flow to go back to work.
I just want to add one more point, basically, that costs are going to decline substantially no matter what. So we are going to see, I mean, think about it this way. A truck driver in the Permian or North Dakota was making 160, 170,000 a year because of the smaller production. We are not going to find those jobs with those high salaries. So this is just a small example on how costs is going to be lower.
This question is from Philip Suarez. Although the panel doesn't see the government injecting capital into oil and gas companies, does the panel see any measure to limit hydrocarbon imports to the United States?
I'll take that.
Oh, go ahead.
Okay. Generally speaking, it's the federal government job to do so. So it's not the states. And if the Trump administration chooses to either stop imports from certain countries or impose tariff, I mean, either way, we are going to see lower imports to the country. The impact basically is extremely limited, if any. So whether, and the reason why, because if you sum up the imports from Saudi Arabia and Russia historically in the last couple of years, for example, the total is about only 1 million. And as you know, the surplus is way higher than that. So the impact is very limited. The other thing is, okay, you take the Saudi oil, you take the Russian oil, well, other countries basically and the traders are going to just swap this oil and swap the ships and supply the same amount to the United States. So whether we have it or not, the impact is almost the same.
Mm-hmm. Yeah. As an economist, I certainly hope that we don't go in the route of trade restrictions. But certainly, I mean, you look at what we import from the crude grades that we do import, they're different from the crude grades that we're producing. So in terms of demand structure, limiting crude imports, we don't import a lot of light sweet crude anymore. That's because we produce a lot of it. We do import a fair amount of heavier crudes for our refineries, and if we put barriers on that, we still need those heavy crudes in order to run our refineries. So I don't think that it would have, like to Anas's point, I don't think that it would be very effective.
Okay, so thank you, gentlemen. Evan Hood, referencing the thought earlier, I believe from Buddy, if the view is that upstream companies go through Chapter 11 or Chapter 7 over the next year intending to sell the company assets, who will be the buyers in this environment? We may have touched on this before. And what can the creditors expect to receive in the market?
Those are both great questions. The buyers we've already seen are private equity groups. In Alta Mesa, it was Mock and Bayou City that bought the assets, albeit after getting a $100 million discount on the purchase price. On some other ones, we've seen where the buyers are also trying to renegotiate the purchase price. In fact, there's a lawsuit in the Approach bankruptcy where the Stalking Horse company is trying to back out of their obligations under the Stalking Horse bid. So who's going to be the buyers? Most likely, I think, opportunistic private equity funds. And what can the banks expect to get? I think they can expect to take some hits this time around. There's historical numbers that the energy lending through the 80s and 90s and all the way through the quick depression 2000 2010, the banks did not take any hits at all to speak of. And really in 2015, 2017, the banks were pretty much insulated from the losses, notwithstanding the number of bankruptcies. But this time around, the banks, I think, are definitely looking at taking some hits, and they should not expect to get 100 cents on the dollar.
It's interesting to me, the implication that if banks are going to take a hit, that means all of your other lenders are toast, right? Because banks are typically front of the line, which means your senior secured debt is zero, your first lien debt zero, your second lien debt zero. We've seen one instance where debtor in possession debt wasn't actually fully paid off. So my expectation is assets you're going to wind up with some unnatural owners, meaning the credit guys or the banks are going to own the assets and they're going to exit them over time, probably cheaply. We're thinking about buying assets in our firm. My expectation is if something was worth $100 million in 2014, I want to pay $20 million for it today in this downturn. So I am expecting to see really cheap asset values emerge from all this.
Yeah, I agree with that. And you're right. That dip lender ended up being the owner yesterday of that oil and gas producer.
Okay, thank you, gentlemen. Let's see. From Kiran Singh, is it that easy to switch back from natural gas to coal in power generation?
It is very easy because all they got to do is increase the utilization of one plant and reduce it in the other.
Yeah, the key is they're different facilities, right? If you're the gas guy, you're turning off your plant, and if you're the coal guy, you're turning it on. So it's not the same facility; it's different facilities. So it's just the market signals having operators turn on something and turn off something.
Philip Suarez, what is the impact for OFS companies, that's oil field service companies, and geophysical services about investing on new technologies, and how might it affect the oil and gas industry?
I don't mind to throw a thought out there. I mean, oil field service is the most challenged area because, an E&P company can stop spending money and still generate revenues. But when E&P companies stop spending money, oil field services don't generate revenues. So I think it's going to be really challenging. Technology is interesting because the cost of switching for new technologies, if oil's 100, you don't want to take any chances of messing up a well. When oil's 20 and there's some technology that's supposedly going to add efficiency or lower your cost, maybe you're willing to take that risk. So you might actually see more technology adoption of new things. Geophysical, primarily around, maybe that's kind of core to what you're doing, but you're lowering your normal spending and you're probably not doing a lot of exploration spending. So I just think OFS is in a tough spot for the next 24 months.
I agree with that, Dan. I think, as always, the oil field service side takes the hit first and hardest. But with respect to the question about technology, I think that the industry really surprised the OPEC countries when prices decreased from 100 to 50, yet we continue to increase production through efficiencies and through technological advancements. And I think the watchword there is necessity is the mother of invention, and I think oil field services guys are going to come around and find cheaper ways to produce and find oil.
Yeah.
May I comment on this, on what Buddy said, because I think this is an important point, that what the service companies basically is their knowledge held, but not their technology in 2015. And their knowledge basically played a role here. And the reason why, because most of the reduction in cost happened by moving to the core of the core, not because of improvement of technology. But to move to the core of the core, basically, that reflected their knowledge. And that's where they played the big role.
Mm-hmm. Yeah, absolutely. On the one hand, you never want to bet against a petroleum engineer whose job is on the line. They surprise us to the upside on productivity every single time. But Anas is exactly right. A big part, when you look at the type curves from on year to year to year on when you across different basins, you see these big increases in productivity in 15 and 16. That was mostly high grading to your top tier resources. And also you saw a curtailment of shallower wells, a curtailment of shorter length wells. So all else being held equal on a per horizontal foot basis, per pound of sand that they were pumping into the ground, there really wasn't that big of an increase in productivity. But you saw the emphasis on where firms were spending money shift share towards longer laterals, more sand per linear foot of pipe, in the very, very best places. And you saw that continue all the way even into last year. Now, but the incremental growth in productivity was smaller. You've seen the incremental growth in productivity shrink every year. Now, there's probably still going to be some of that this year. Not much. You've seen the lateral lengths kind of hit their engineering limits for a lot of plays, or what seems to be their engineering limits for a lot of plays. The amount of pounds of sand per foot of pipe that they're putting out there has stabilized. And so those areas of low-hanging fruit for productivity growth have seemed to have been spent. And so you're seeing a lot more emphasis on other areas, operational, supply chain, technology. You're hearing a lot of talk about machine learning and really mining this incredible database that they have for all kinds of ingenuity to find that every avenue they can to squeeze extra productivity out. So I think the productivity growth is still going to be there. It's probably still going to surprise. But I think the incremental growth in productivity that we've seen over the last years is probably going to continue to diminish, or at the very least continue to slow because of these physical. We've learned how to do shale pretty well. We just haven't figured out how to make money at it until just recently.
And this is I guess a comment for myself. A lot of we're talking about technology, and so that Google now has an oil and gas division. Microsoft has an oil and gas division. Amazon has an oil and gas division. What are your thoughts on, and Jesse, you touched upon it, the industrial Internet of Things? There's a well-known company here in Houston that's doing blockchain in oil and gas. There's a company that's using satellites to, track water in the Permian Basin, for example. What's the panel's thoughts on technology kind of increasing efficiency going forward?
I would like just to mention a couple of comments here. The first, we have to remember that the fourth revolution basically is really about sensors, monitors, and big data. And there is a big role for big data and sensors in this case to reduce costs, especially when we talk about the lower number of engineers graduating from university, etc. There is a pressure basically to reduce that, and big data helps with reducing the number of human resources that are needed for each operation. But in terms of big data, they can help in so many ways increase the productivity and increase efficiency. But the last thing I want basically is for Google or Amazon to be the operators. So they can help in terms of servicing, in terms of the data, and even data storage in this case, and big data analysis, but we don't want them around the operations at all.
And then I'll just add to that point, Dr. Anas. What I've noticed is, for example, Microsoft. There have been some of my colleagues in the Geophysical Society of Houston that have been hired, and I think some of the tech companies are seeing that they don't understand the industry, and they're humble enough to be able to, hire former geoscientists and operators to come in, and I think that's definitely the way to go. What are your thoughts on that?
Well, that's what's been happening. Basically, they've been hiring people from the oil industry so they can develop the software and do the analysis. In fact, we heard about a company in the Bakken that bought the data from various companies. It does not have a single petroleum engineer, and they did the analysis, and they found out that there are certain areas where wells were producing around 300 barrels a day, while all the neighbors were producing 800 to 900. The problem is they realized that there is an opportunity there, but they needed people from the oil industry to explain all of that to them.
Okay, perfect. So, well, gentlemen, I'd like to thank you for your time. I appreciate everybody for joining us early in the morning at 7 a.m. So Dan is going to do a brief summary for us and wrap us up. And we look forward to seeing you, everyone, on our next panel. So, Dan?
Sure, and it's going to be a very brief wrap up. First of all, Jesse, Buddy, Brian, and us, thank you. You guys really helped shed a lot of light on a lot of issues. We covered a lot of ground. I think that as I sort of quickly skimmed back through my notes, what would my wrap up be? I mean, it's a fairly somber outlook here. Things are tough. They're probably going to stay tough for a little while longer. Bankruptcies numbering in the hundreds. We're talking about banks potentially taking assets, credit being impaired, et cetera, et cetera, et cetera. This is a challenging situation for the industry from a macro perspective. We got to watch the demand recovery. And I think I heard fairly solid data points on that, assuming we don't have a coronavirus resurgence. And so, that continues to be a wild card that none of us on this webinar can really know or understand. So watching the healthcare side of this is something we'll all have to do. The industry is taking actions into its own hands. We don't expect proration, but industry shutting in, reacting to the economics, not super concerned about the ability of the industry to respond back on the supply side. Some thought that this is going to be an opportunity set for large and external players to come in and buy assets and consolidate. Consolidation is coming, some sooner, some later. Natural gas emerges here as a winner on the margin, with a view that the associated gas that's getting shut down is going to be bullish and demand is going to be okay. Private equity hanging around the hoop, smashing companies together, will step in and deliver capital to the market at some point in the future. And generally an expectation that this industry is, and I completely agree with this, this industry is resilient and necessary. And so we'll wind up muddling through this. It will not be pretty, but there is an industry coming off of the backside here. So that's my takeaway from all of the comments from the panelists and interspersing a little bit of my own thought there as well. But I think everybody did a great job of helping us understand the market outlook. And so when we do this in a year, I'm going to come back and remind everybody of their over-under answers, and we'll see who is the best prognosticator. So thanks to everyone. I'm going to go ahead and sign off, and I really enjoyed it. Thanks to the thing for the opportunity.
Thank you.
Thank you, Dan. Thanks, everyone.
Thank you, Dan, and thank everyone else. We'll be wrapping up now. We look forward to joining you on our next session of the State of Oil and Natural Gas, hosted by the Financial Executives Networking Group. Have a great day. Stay successful.